Is the private equity firm Blackstone misleading or even potentially defrauding their investors? Well, financial analysts and hedge fund managers seem to imply that the firm is maybe doing that when it comes to one of the real estate investment vehicles they offer to investors. Now, the average investor in this investment vehicle contributes about $70,000 to it. So when you think of private equity firms, obviously you think of like super wealthy people, but they've been marketing this investment vehicle to some normal everyday investors. $70,000 obviously is a lot of money. I'm not minimizing that, but to me that sounds more like people are looking for something to invest, like some of their nest egg in for retirement. It's not like they're putting in, an average of $1 million or more. But this real estate investment vehicle is called BREIT. And the problem is a huge portion of that portfolio is heavily invested in risky real estate. I'm talking about commercial real estate like office buildings, warehouses, retail buildings. And if you look at what the economy is basically showing us as it pertains to commercial real estate, it's a really bad investment. But something really strange is happening because BREIT has been showing impressive returns while the rest of the economy is showing massive dips in commercial real estate. So look, it all started as a huge success. As Business Insider writes, by offering an annual dividend of about 4% in a world where interest rates were close to zero, BREIT quickly became a giant. At its peak in 2021, the fund was attracting as much as $3 billion a month in new investments. Today, BREIT boasts assets of $114 billion, about 8% of Blackstone's entire fee earning assets, and has generated over $5 billion in management and performance fees. Now, understand how these private equity firms work, right? Private equity firms allow for investors to invest in private businesses or private entities. These are investments that you cannot make through the publicly traded stock market, right? And so there are certain regulations that impact the stock market that do not impact the investment vehicles offered by private equity firms. So something definitely seems off. So despite the commercial real estate industry getting like totally battered by high interest rates and the impact of the pandemic, all of a sudden you're noticing the opposite is happening with Blackstone and the BREIT offering they have for investors. In fact, since its inception, the fund has delivered an annualized net return of 10.5%, and that's double the index of publicly traded REITs. And REITs are basically investment funds having to do with real estate. Now, to be fair, the fund did crash temporarily when interest rates began to rise. And this is back in 2022. Investors got super panicky about it, and they tried to cash out of BREIT. So in the fall of 2022, after the Fed's interest rate increases began to shake the commercial real estate market, investors began asking for their money back, more than $15 billion to date. Faced with a run on the fund, Blackstone cited a provision that allowed it to take its time refunding antsy investors, a decision that only served to further alarm the markets. They didn't have the liquidity to pay the investors when they wanted to cash out of the investment vehicle, which is not a good sign. So shares in Blackstone tumbled nearly 20%. Last year, though, BREIT failed to generate enough cash to cover its annual dividend.
Pausing here to deliver some honest truth as we do in our news coverage as well. TYT is facing challenges, guys, as the entire industry is. You know who could make the difference? You. If you hit the join button below, it's gonna make all the difference and keep us in business. We appreciate you, thank you.
But it did rebound, especially in recent months, which is a red flag. Because again, commercial real estate has not improved in the last few months. BREIT announced it was able to fulfill 100% of its repurchase requests it received in February, which had slowed to just under $1 billion. Amid the promise of a rebound, Blackstone stock has gained almost 50% from its lows. quote, I believe we'll look back at 2023 as the cyclical bottom for our firm, Steve Schwartzman, Blackstone CEO, told analysts at an earnings call in January. But what's really going on? How did it rebound? How does that make any sense when commercial real estate has not rebounded? And by the way, let's take a quick look at what the portfolio for BREIT looks like. What are they invested in? So look, as you can tell, they do have some sound investments here. I mean, sound for investors, not so sound for people looking to protect affordable housing, because overall, housing makes up 53% of the real estate in BREIT's portfolio. And that is a solid investment considering rent and the price of housing has really gone up, and that translates to major gains for these investors. But that's not the case with the rest of this portfolio, because the rest of the fund mostly invests in riskier real estate like industrial buildings, offices, data centers, and retail. Now, considering that's the type of real estate that has in fact taken a sharp dip in value in recent years, how exactly is Blackstone able to continue boasting such impressive returns? Well, this is where Bethany McLean, who's a journalist over at Business Insider, comes in. She starts asking some tough questions. And for her story, she spoke to all sorts of experts to try to get a handle on what's happening here. She spoke to veteran analysts, accountants, and investors. And they're all under the impression that BREIT is a risky bet, which is why hedge fund manager Nate Kopakar shorted BREIT. And he says this: it is the absolute definition of a Ponzi scheme. Unless the real estate market comes roaring back, analysts warn, BREIT could end up shrinking to a fraction of its current size, leaving the fund's investors holding the bag. And guess what? One of the bigger investors is the University of California system, which dedicated $4 billion of their endowment to this investment vehicle. So let's take a listen to Blackstone Group President and COO Jonathan Gray discussing the UC investment on Bloomberg just last year.
This is a big win for us. It's a big win for BREIT. It's a big win for the University of California, who's making this investment. $4 billion of common stock into BREIT with a minimum effective hold period of 6 years.
But that's not the full story, because Blackstone actually had to sweeten the pot in order to convince the UC system to invest in BREIT. Take a look.
One thing about this investment, as far as the terms go, they do have a preferred minimum return that they're going to be getting. It's something that's guaranteed to them. Why wouldn't another average investor look at this and say that's preferential treatment?
So the way to think about this transaction is they're actually coming in as a common shareholder at the BREIT level with this $4 billion fresh investment. They're taking that investment, and then we're taking $1 billion of our existing holdings and putting it in this strategic venture. It does give them a minimum return. It gives us some upside participation.
Wait, hold on though. If BREIT has impressive returns, why would Blackstone need to sweeten the deal for the UC system by guaranteeing them a minimum return? If it is a portfolio that's performing so well, wouldn't you have to fight institutions and investors off who want to invest in the fund? Now, Blackstone went even further to attract the UC system than what was communicated in that video. According to reporting, to entice the university to invest, Blackstone had offered it a special deal. BREIT agreed to award the university an additional $1 billion in stock in the event that the fund's rate of return fell below 11.25%. The deal was so sweet that UC's Board of Regents quickly agreed to invest another $500 million on the same terms. But financial analyst Craig McCann told Business Insider, this is not a good sign. Quote, contrary to Blackstone's spin, the University of California investment strongly supports the view that BREIT is a terrible investment. Okay, so McCann made himself clear. By the way, he used to work as an economist for the Securities and Exchange Commission. He also wrote last year that investors should not accept anything that Blackstone and BREIT state as truthful. He says, quote, surveying some of the ways that Blackstone has misled investors over the past 5 months, we are more convinced than ever that BREIT is a bad investment created for the benefit of Blackstone. And remember, since we're talking about an investment vehicle offered to regular people by Blackstone, a private equity firm, the fund is not publicly traded and does not have to abide by similar rules that companies traded on the stock market would have to. And as a result, it's impossible to know what the true value of BREIT actually is. So BREIT's returns, by the way, are based on a measure called net asset value, or NAV. Okay, so NAV is calculated, but using the value of all of the assets that the fund owns minus the debt, okay, the debt liability. Now, BREIT doesn't let investors or regulators see some of the crucial assumptions that go into the calculations they make for NAV. And as BREIT's financial documents state, Blackstone is ultimately and solely responsible for the determination of our NAV. The methods used to calculate it are not prescribed by rules of the SEC or any other regulatory agency, and the NAV is not audited by our independent registered public accounting firm. And that is a problem, a huge problem. And so you have, analysts saying there's a lot of misleading stuff going on over at Blackstone in regard to this investment vehicle. Chilton Capital Management analyzed the way that Blackstone adjusts the value of BREIT and how those changes are reflected in their estimates, in their analysis, rather than being marked to market every day or every millisecond like public REITs. Blackstone adjusts its NAV on a monthly basis. In today's volatile real estate market, that means its stated value can lag way behind reality. It inherently is a flawed process when prices are changing quickly, Chilton Capital Management observes. We refer to this imperfect appraisal process as mark to magic. And going back to McCann in a second, I just want to note that Chilton has concluded just this past April that BREIT is overstating the value of its NAV by more than 55%. McCann, who we heard from earlier, reached a similar conclusion. He calculated that the cumulative returns of other funds in the sectors in which BREIT is concentrated, meaning like real estate, commercial real estate, plunged by over 30% in 2022. Yet BREIT claimed that its value increased during the same period. In the dry language of market analysts, McCann called the fund's claims about its NAV unreliable. And there are other shady things at play that you should know about. So Blackstone is absolutely incentivized to overvalue its NAV because of the fact that, the higher that number is, the more they can charge investors fees. It's a textbook example of conflict of interest. Robert Chang, the head of securities litigation at Fideris, a consulting firm that specializes in investigating corporate wrongdoing, wrote in a piece about BREIT. Fideris calculates that since early 2022, the fund's NAV per share has remained relatively stable while public REITs have lost more than 30% of their value. If BREIT's assets are indeed overvalued, Fideris estimates investors may have overpaid management and performance fees to the tune of hundreds of millions of dollars. So there is a conflict of interest there when it comes to Blackstone overstating the value of this investment vehicle. And perhaps the most damning line in this Business Insider report is the following. Many of the data centers Blackstone says have already created so much value for the fund aren't even up and running yet. They're still in development. Growing up, my dad would tell me, don't invest in the stock market. You thought that it was evil for a whole host of reasons. I mean, look, that was not good advice, but this is the kind of stuff that he was referring to. Because if you're an ordinary investor, you worked real hard, you've got a, okay nest egg and you're hoping you could live off of that. Imagine investing it in some risky vehicle like this as you're being potentially lied to about the value. So we'll see how this story develops, but it's not looking good for those who have decided to invest in BREIT, especially given what we're noticing in other areas of our economy, or not even other areas of our economy, but other investment vehicles that are heavily invested in commercial real estate.
Thanks for watching. If you become a member, you get to watch all this ad-free, except for, of course, this ad. Still, hit the join button below.